Good morning. It's Jeffrey Christian of CPM Group. It's 11:30 in the morning here on Friday, the 28th of February in New York. I want to talk today about silver deficits and the non-existence thereof. This is an excerpt from our Silver Facts and Fantasies webinar that we did on Wednesday of this week. That was a 2-hour event. At some point, it probably will be posted on the internet. But this is one part of that I wanted to cover. I also will talk a little bit about the state of the economy, since it seems to be weighing heavily on gold and silver as well as other commodity markets this week. And then a little bit on the recent price activity of gold and silver, both of which have fallen this week, and the situation vis-a-vis the February roll of the March COMEX silver futures into May, which has largely occurred over the course of the last 3 weeks, 4 weeks. So a lot to cover with today. Unfortunately, I'm going to start by a little bit of boring history. What CPM Group is. This is a series of reports going back to like 1972, I think, is that silver thing in the top. When we were part of J. Aron, I wasn't working at J. Aron in 1972. I came in 1980. But J. Aron produced basic data on silver. The other company that did that was Handy and Harman, which was a diversified refiner and semi-fabricator and fabricator of silver products. And Handy and Harman made that little booklet in the upper left-hand corner here every year. And they had done that since at least the turn of the century, the last century. We had a series of their reports. J. Aron's reports went from the silver reports in 1971-72 to the report on the top right side, a nicer presentation and a more thorough data. Our two companies cooperated with each other and came up with estimates of supply and demand and investment demand and inventories for silver together. Handy and Harman stopped publishing its reports in the early 1990s after CPM Group had left J. Aron and Goldman Sachs, but I'm jumping ahead there. We had a cooperative relationship with a company, Consolidated Goldfields, which no longer exists. Consolidated Goldfields was a gold mining company in London, and it and J. Aron shared consultants around the world who helped cobble together gold supply and demand statistics too. After Handy and Harman left, it was really just CPM Group. On the bottom row, you'll see 4 reports. The one on the left is the first 1990 World Silver Survey, which CPM Group produced for the Silver Institute. The next one over, the Silver Report, Precious Metals, Silver, that is a quarterly survey that CPM Group started producing in 1987. We left Goldman Sachs, J. Aron in 1986 and set up as an independent, unbiased, non-conflicted purveyor of precious metals and commodities research and consulting services. And we've started producing quarterly reports on silver, gold, and platinum group metals, as well as currencies and copper and other commodities at the time. That silver survey that we produced turned into the Silver Yearbook using the 2021 version. And you can see that we also have that translated into Chinese and distributed in China by the Huatong Silver Exchange. So we produce a tremendous amount of research, basic research, and we continue to produce it. And we have been producing it for decades. For more than half a century, this research operation has been producing the definitive data and analysis on silver and gold. We added platinum group metals in 1980 when I came to J. Aron and started managing the research operation. Yes, we created the World Silver Survey. And it's interesting because the Silver Institute, I guess this week or last week, came out with a report um, on above ground silver inventories and their price sensitivities. And it's very interesting because the data that they use basically is the CPM Group data for the most part up until 1995. We started producing the World Silver Survey in 1990. We had a 5-year contract initially. After that initial 5 years, we did not want to continue to produce the World Silver Survey. So the Silver Institute went out and found some people who had never done any silver research, and they hired them to continue to produce that report. Um, we didn't like working for the Silver Institute at that time. We found that people thought that we were being more bullish than we really were because of our relationship with them. We were not. Within the Silver Institute, there were members who were pressuring us to be more bullish, even though our contract, our 5-year contract, said that we had total editorial control. And we insisted on that because we knew there would be pressure from some of the Silver Institute members to be more bullish. We were not. We refused to be. We refused to skew our data to make a more bullish story. And so after 5 years, we went our separate ways. That's important to know because of what we're going to be talking about is why there are no silver deficits. You've probably seen this in presentations. It's from our silver yearbook. We have been producing this data and adding to it every year since the 1970s. There are about 60 billion ounces of silver that are estimated to have been mined over time. About half of that, 30 million ounces, billion ounces, have been lost. Industrial use, used in products that cannot be recovered or don't make economic sense. Mirrors, ball bearings, solders, things like that. Although a lot of solders actually are, in fact, refined and recovered the silver from it. And then about 27 billion ounces estimated in jewelry, decorative objects, religious objects, and about 5.5 billion ounces in silver bullion and silver bullion coins. Um, that's the silver that's out there. It's interesting because, as I say, we can account for, or we can attempt to account for with a reasonable level of surety about 27 million of that 60 billion ounces, so slightly less than half. The same data for gold, which is in our gold yearbook, shows that we can account for, with a reasonable amount of surety, 90% of the gold. And I explain it very simply. If you lose a gold coin, you go out and you find it. If you lose a silver coin, especially the old circulating silver coins, and you drop it or you lose it someplace, you don't necessarily spend a lot of time looking for it. A nickel, a dime, a quarter, which used to have silver prior to the 1960s, or some of the European coins, which got switched away from silver 1979, 1980, when the price of silver went from $5 to $21 on an average basis in 2021, or 1980, I mean. So silver being less valuable per ounce, people were more cavalier about not refining it and recycling it from manufactured and fabricated products at the end of their lives, and they were more cavalier about not about losing coins. So about half of it, more than half of it, seems to be gone. Now, these are our annual surpluses and deficits in silver, current newly refined silvers. This is newly refined silver is supply. It's from mine production and secondary recovery and fabrication demand. We don't include investment demand because investors do not use silver. The silver that investors buy stays in bullion form. And I'm going to repeat that several times because it's critical. And there are some people who simply don't want to believe it or acknowledge it in public. But it's true, right? So net additions to silver inventories, generally speaking, come about when investors are bullish on silver and they bid the price up, oftentimes coinciding with weaker economic conditions where fabrication demand is falling. As the price rises, supply increases, and fabricators pull back insofar as they can on the amount of silver they're using. So you have a surplus, which coincides with higher prices. You can see the red line, which is the silver price. Surpluses coincide with rising silver prices. Deficits coincide with flat to lower silver prices. It's very important. And we have surpluses that appeared around 2006 and continue to grow. They got very large as the silver price went from $5 in 2005 to $50 in 2011 on an intraday basis. You were seeing 170, 180, 200, even up to about 240 million ounces of silver being added into above ground inventories held mostly by investors over that period from 2006 to the present. It was most intense from around 2008 into about 2014. It came down to less than 1 million ounces around 2016. And you can see the silver price decline too. It got down as low as 50 million ounces, our estimate, based on our research. In 2023, it got up to about 72 million ounce surplus in 2024. And our estimate is it's going to be around 150 million ounces this year, which could cause the silver price to stay strong and move higher. But there are no deficits. These are surpluses. And if you want to see a higher silver price, you want to see surpluses because the surpluses indicate that investors are buying silver. Yeah, there are a lot of investors who get bullish on silver predicated on the fundamentals. Oh, there's a deficit which doesn't exist, but fabricators are going to use a lot of silver. Fabrication demand for silver is price sensitive. When the price of silver rises, fabricators try to reduce their per unit silver use or find other metals to use. And in many applications, there are substitutes. Right? You can see silver prices rise based on rising fabrication demand up to a certain point, but the price mechanisms of mine production, secondary recovery, and fabrication demand limits the extent to which silver prices can rise based on those fundamentals. If you look at the periods of time when silver prices have risen, they've risen because investors raced into the market and bought a lot of silver. Yeah, more than 200 million ounces in 1980. 1979, 1980 saw a strong demand for silver. And then more than 150 million ounces for 8 years from 2008 into about 2014, 2015. It got very low and the price came down. It started to rise and the price rose. If you want to be bullish on silver, you have to expect investment demand to be strong. You cannot develop a credible scenario where non-investment demand, fabrication demand, drives the silver price higher. The only way you can do that is to make up wild numbers about how much silver is going to be used in solar panels and electric vehicles and missiles and military ordnance and other things, and just make up numbers. Now, the disappearing deficits. The deficit data comes from the Silver Institute's data since 1994, when we stopped working on the World Silver Survey. The people who took over that report added investment demand into with fabrication demand and said, if you look at demand the way we're measuring it, fabrication demand and investment demand, it exceeds total newly refined supply. So just over the last 4 years, 93 million ounce deficit ballooning to 261 million ounces in 2022, 189 and 182. if you look at it and you say, where does that deficit come from? It comes from what we think are too high of investment demand figures. 284 million ounces in 2021, 337 million ounces in 2022, 243 million ounces where we thought it's probably closer to 50 million ounces of investment demand in 2023 because there was a lot of silver being sold by other investors. Yes, investors were buying a lot of silver, but a lot of other investors were selling it. And one of the things that we saw in 2023 and in 2024, especially the first half of 2024, was that coin dealers play their industry different ways. And some coin dealers use low prices to sell silver. They're lower relative to everybody else. And other coin dealers have higher prices to buy the silver back. And what we saw in 2022, 2023, 2024 was that savvy investors knew if I want to buy silver, I'm going to go to that guy because he's giving me slightly lower prices. But if I want to sell my silver, I'm going to go to a different coin dealer who has a better resale price. As a result, if you only survey some of the coin dealers, you get the story that a lot of investors are buying silver. If you only survey the other guys, you get a story, oh, a lot of people are selling silver. You have to have a representative survey across the market, and you have this guy. And, I can tell you, we have coin dealers that we talk to regularly who say, oh, yeah, so people are still buying silver hand over fist. And, even though the price is $28 or $30 or $32, no one's selling this stuff. And then you have other coin dealers who say, I had to close down because I ran out of cash to buy silver. And you see that now, and you've seen that it's been apparent for about 18 months in the market, but it's become much more apparent over the last 6 months or so when you started to see really a big flow of silver being sold by investors, taking advantage once the price rose above $30. So you take out that investment demand from those deficits, and all of a sudden you have surpluses. And those surpluses are actually kind of close to CPM Group's estimates of surpluses. There are no deficits if you do your arithmetic properly and you don't count investment demand as a type of fabrication demand where the silver is being used. You just can't do that. And if you do, you're going to be more bullish than you should be. There's a lot of above ground refined silver bars and coins, about 6.5 billion ounces right now. About 2.3, I think, are in coins, another billion ounces in ETFs. And then a lot of it is in unreported inventories that investors don't necessarily report to people that they own. It's interesting. I mentioned the study on the price responsiveness of above ground inventories that the Silver Institute had somebody produce recently. And, you go back, our data goes back, some of our data goes back to 1970, some of it goes back to 1950, some of it goes back to 1900. And as I showed you, some of it goes back to antiquity. If you go back to a 1950 starting point or a 1970 starting point, we have a lower number of estimated amount of silver that was in above ground bars and coin forms than the people who did the Silver Institute report. So they have a higher level. Oh, actually, I'm not sure that they have a much higher level of silver in above ground inventories than we have, but they had a higher starting point. So the world's not running out of silver. People ask us how all the time, and they asked us several of the questions that we received for the Silver Facts and Fantasies to our webinar open forum was how many years of deficits before the world runs out of above ground refined inventories. Now, arithmetically, you cannot compute that because there are no deficits. Yeah, if you want to say there's 6.5 billion ounces of silver and there's a deficit of, 200 million ounces of silver, you can divide one by the other. But we don't have deficits. The investment demand that people report, when an investor buys that silver, the investor holds it in above ground refined inventories. That's what above ground refined inventories are: investment demand. Yes, banks own some and they lease it out to miners and refiners and smelters and fabricators and others who want to borrow it. And there are working inventories in the industry that's owned by those miners, refiners, smelters, and fabricators. But the vast majority of this metal, especially the implied unreported inventories, are held by investors. 2.3 billion ounces of coins definitely are in investor hands. The ETFs definitely are in investor hands. Fabricators and producers and refiners and smelters can't use coins and can't use ETFs. They have to use bullion. So of those 2 billion ounces or so that's in bullion form, part of that is industry stocks. And the industry includes the financial intermediaries who own that stuff and lease it to manufacturers and others. But part of it, perhaps half of the unreported materials, actually is owned by investors. I know I don't report my silver, and I don't think most investors do. I know we always tell our clients not to do it. So since there are no deficits, you can't calculate how many years of deficits before the world runs out of above ground inventories. It does not compute. Sorry. Now, the state of the global economy and the U.S. economy, we have seen some really bad data: higher unemployment filings, greater layoffs, the government losing a lot of high-paying jobs. We've seen business equipment investments decline. Big companies are not building new plants as much as they used to recently. They're not hiring people. They're not buying equipment. The world and the U.S. seem to be heading toward a recession, even as inflation has stalled out and started to show signs of increases. This is the disposable personal income, the personal consumption data that off of which the PCE, price change indices, are built. And you can see here in January, something big happened. There was a big surge in disposable personal income. That's the blue bars here. And there was a big decline in expenditures. People actually were making an increased amount of money, and that black line is savings. The savings rate went up. People were doing well financially, but they stopped buying. And if you take a breakdown, I didn't include the table here, and you say, well, what weren't they buying? Automobiles sales fell 41% year over year. Other high-ticket items fell. The big declines in personal expenditures, or what the Bureau of Economic Analysis calls outlays, were in things. People pulled back on buying things in January. They increased their savings rate, and that extra money that they had coming in, they put in savings. Why do they do that? Because they are frightened about where the U.S. and global economies and political systems are going. And the way you get into a recession is you have people and companies and governments reduce the amount of money they're spending. So those lights are flashing, maybe red, maybe yellow. If you look at the price indices, the yellow is the personal consumption expenditures price index. The blue one excludes food and energy. Blue fell more than yellow because it excludes that food and energy. And as I said, what you really were seeing was pullback in people buying things. So you had greater weakness in the auto sector, for example, than you did in the food sector. People were still buying food and eating it, and then they had to buy more, but they weren't buying cars and other stuff, consumer durables. So, yeah, the warning signs are flashing. Let's talk a little bit about gold and silver. Gold prices, gold prices are off $47 from yesterday's close as I speak right now. It's $2,848. It was off $50 from that. And it's been falling for several days, as you can see here. We got very close to $3,000 over the last 2 weeks, so the second half of February. We got up to about $2,975, $2,980, but we've backed off. There's some seasonal stuff that's there, but it's really investors backing off from it. So we're looking for that to continue. Now, February was an active delivery month in the COMEX futures market. And you can see in the upper right-hand corner, about 7.7 million ounces of futures contracts were delivered, right? That doesn't mean that 7.7 million ounces of gold were delivered. It could have changed hands, but there's a lot of trading companies that will stand for delivery once you get into the first delivery day, which is the last business day of the previous month. They'll stand for delivery, they'll see what they get delivered, and if they don't like it, they'll deliver it back onto the COMEX. And you can actually see an ounce of gold or a 100-ounce bar of gold get delivered several times during an active month. But 7.7 million ounces was a very high level of deliveries in the course of February. And that reflects some of the things that we've been seeing and hearing about with the arbitrage opportunity where people were buying gold in London and selling it in the COMEX. So that was what was going on there. Our expectation is that the price will dust itself off and move over. Probably over the next 2 months or the greatest period of time. Once you get into the second and third quarters, it could back off a little bit, but it's probably not going to back off a lot. I think we're probably talking about a floor around $2,750 in the near term. It will take a much more sanguine economic and political environment for investors to back away from buying gold. And what you're going to see, and what you're probably seeing today even, is that as the price comes down, some investors and central banks will say, hey, I will be buying more now that the price is off, because I've seen since January 1st how fast gold prices can rise. Gold started the year $2,660. It almost got to $3,000 within the first 2 months of the year. And our governments around the world promise to help stimulate investment demand for gold and silver going forward. Silver prices, similarly, they rose from about $29 at the start of the year to a little over $34. We were thinking that it could go to $35, but instead, over the last week or so, last several trading days, you've seen the silver price back off. As of now, it's $31.40. That's off 70 cents from yesterday, and it's off, $2.50, $2.60 from the peak 2 weeks ago. Again, we expect the price to dust itself off, and we wouldn't be surprised to see the price come back up in late April, probably, and maybe test 34 again, but maybe go above 34 and test 35 the way it did at the end of October. This is some data. I hope you can see it. This is the open interest in the March active COMEX silver futures contract and the May, which is the next one. And you can see on January 1st, there were 600 million ounces of March delivery. And you heard people on the internet saying, oh, there's no way that you're going to deliver that much silver. It's going to be the collapse of the paper market, et cetera, et cetera, et cetera. Never paying attention to the reality, the historic reality, that you often have large open interest in a nearby active contract. And as you approach the first delivery day, which is the last trading day of the previous month, you see a lot of that roll. By the end of January, the open interest in March was 612 million ounces. And you had about 150 million ounces in the next active month, which is May. By February 4th, just 3 trading days later, it was down to 606 and up to 156 million ounces in May. By the 13th of February, you were down to 452, so you'd lost, a quarter of that open interest in 2 weeks. And May had risen to 268 million ounces. And then I have the last 5 trading days here, where it went from 264 million ounces of March open interest on Monday to 109 million ounces on Thursday, yesterday. And May has gone from 456 million ounces up to 568 million ounces. So the roll is happening and the price is coming off. The price is coming off because gold and silver prices, as well as copper, platinum, palladium, and a host of other commodities, are selling off because of the economic and political anxieties that are causing people to say, I want to hoard money because I am really worried about where our country's going and where the world's going. And I think it's time to have money. When people get really scared, they buy 4 assets: US dollars, US treasuries, gold, and silver. In 2023, overseas investment in US treasury securities rose 10.5% to a record $8 trillion. In 2024, it rose 15%. People around the world are hoarding dollars, treasuries, gold, and silver. And they'll continue to do that until they're more comfortable with the economic environment. Now, in the good old days, you'd have 1 or 2 years of economic crises, and then things would get better and people would buy less gold and silver. But since 2000, 2005, that's changed. And you've seen investors facing one crisis after another, exogenous variables, external crises in the political or economic or financial market, one after another since the turn of the century. And investors have said, I need to buy more gold and silver and keep it. I need to protect my wealth and diversify my wealth with gold and silver. And that's going to continue. Meanwhile, the noise will continue now. So you've got 568 million ounces of May open interest. You will hear people say, oh, that's going to break the COMEX. It's going to break the paper silver market. It's not. That's the way the market works. And if you pay attention to the market, and if you look at the statistics, which are available at cmegroup.com, or in our silver yearbooks, or in our precious metals advisory, if you understand the way financial markets work, you know this isn't going to be the break of the system. The same way, if you are a government official and you've been jerking the economy around since the 1950s, especially since the 1980s. In 1980, we had $1 trillion of federal debt. And the deficit had gone from $54 to $58 billion. And the Reagan administration said, well, supply side economics, that's going to fix that. We're going to get rid of that deficit by slashing taxes. And within 2 years, we had a $230 billion deficit, and we had $1.5 trillion worth of debt. Now we have $36 trillion of debt and a $1.7 trillion deficit, which probably is going to be closer to 2.7 in the next fiscal year. And over the last 45 years, since supply side economics was introduced, or as Dick Cheney said when he was vice president, deficits don't matter anymore, at least not for elections. Over that 45 years, you've constantly heard people say the treasury market's going to break. You can't have $2 trillion worth of debt. You can't have $7 trillion worth of debt. You can't have $17 trillion worth of debt. And now you've got these guys in Washington saying the country's going to go bankrupt because we have $36 trillion worth of debt. Now, $36 trillion worth of debt is a bad thing. But if you think that's going to drive the U.S. government into bankruptcy, you ought not to be involved in the government, because you're saying, I don't know squat about financial markets and global economics. I'm sorry, but it's true. Yeah, this is a clown car. And the gold and silver promoters love it because they've got a very similar clown car. That's all I have for now. Sorry, long time, a lot of stuff to cover. We will not be doing a video next Tuesday because we will be at the the Prospectors and Developers Association of Canada, the PDAC, annual mining conference in Toronto. We'll be back next Friday. In the meantime, take care of yourself, take care of those around you, try to do something good for the world, even if that's just finding something accurate to read about the political and economic mess that the world is in. We'll be coming out with our gold yearbook later in March, in silver yearbook in May, and our PGM yearbook in July. In the meantime, you can go to our website. You can pre-order the yearbooks. You can buy last year's yearbooks. You can subscribe to the Precious Metals Advisory. And you can send us an email at info@cpmgroup.com asking us to talk with you about how we can help you better manage your price exposure to precious metals and commodities. Take care. We'll talk to you in a week.